Now I'm going to talk about the profitability ratio. Every firm is most concerned with its profitability. One of the most frequently used tools of financial ratio analysis is profitability ratio, which are used to determine the company bottom line and its return to its investors. Profitability measures are important to company manager and owner alike. If a small business has outside investors who have put their own money into the company, the primary owner certainly has to show profitability to those equity investors. Profitability ratio show a company overall efficiency and performance. We can divide profitability ratio into two types, which are margin and return. Margin ratio is the ratio that shows margin represent the firm's ability to translate sales dollar into profit at various stages of measurement. Margin ratio include gross profit margin, operating profit margin, net profit margin, and cash flow margin. Gross profit margin looks at cost of goods sold as a percentage of sales. This ratio looks at how well a company controls the cost of its inventory and the manufacturing of its product and subsequently pass on the cost to its customer. The larger the gross profit margin, the better for the company. The gross profit margin ratio is calculated by dividing gross profit and net sales. Both terms of the equations come from the company income statement. The second one is operating profit margin. Operating profit is also known as EBIT and is found on the company income statement. EBIT is earning before interest and tax. The operating profit margin looks at EBIT as a percentage of sales. The operating profit margin ratio is a measure of overall operating efficiency, incorporating all of the expenses of ordinary daily business activity. The operating profit margin ratio is calculated by dividing EBIT and net sales. Both terms of the equation come from the company income statement. The third one is net profit margin. Net profit margin is the most often margin ratio used. The net profit margin shows how much of its sales dollar show out as net income after all expenses are paid. For example, if the net profit margin is 5%, that means that 5 cents of every dollar is profit. The net profit margin measures profitability after consideration of all expenses, including tax, interest, and depreciation. The net profit margin ratio is calculated by dividing net income and net sales. Both terms of the equation come from the income statement. Next is cash flow margin. The cash flow margin ratio is an important ratio as it expresses the relationship between cash generated from operations and sales. The company needs cash to pay dividends, supplier, service debt, and invest in new capital assets. So cash is just as important as profit to a business firm. The cash flow margin ratio measures the ability of a firm to translate sales into cash. The cash flow margin ratio is calculated by dividing operating cash flow and net sales. The second of the profitability ratio is return ratio. Ratio that show return represent the firm's ability to measure the overall efficiency of the firm in generating return for its shareholder. The one of the return ratio is return on asset ratio. Return on asset ratio is an important profitability ratio because it measures the efficiency with which the company is managing its investment in assets and using them to generate profit. It measures the amount of profit earned relative to the firm level of investment in total assets. The return on asset ratio is related to the asset management category of financial ratio. The return on asset ratio is calculated by dividing net income and total assets. Net income is taken from the income statement and total assets are taken from the balance sheet. The higher the percentage is better, because that means the company is doing a good job using its assets to generate sales. Another return ratio is return on equity ratio. The return on equity ratio is perhaps the most important of all the financial ratios to investors in a company. It measures the return on the money the investor have put into the company. This is the ratio potential investors look at when deciding whether or not to invest in the company. The calculation is dividing net income and stockholder equity.